Hey there guys, welcome to this month's edition to Technically Speaking. As always, I'm joined by, the three amigos. We've got Mr. Andrew Gibbs, Mr. Mitch Olarenshaw, and my good self. So
Dumb and dumbest. Welcome, gentlemen. How are we?
Good.
How are you?
Spotting the odd one out, you need to get some facial hair. I reckon if we give you about another 4 years, you can get a beard growing.
I hope so. Hopefully my beard growing is as good as your stock picking, Mr. Andrew Gibbs. And I guess that's the motto of today's broadcast is how well you've actually picked the market.
Great segue, and absolutely hats off to you, my friend. It's just been a great run that continues to go. And of course, the big one will be signal screener finally turning red. In fact,
Finally.
Yes. What are your thoughts on that?
Says the market could be going down. We're in a risk-on area, which means if there is going to be a fall, it could come from these levels.
Interesting. Are we able to bring the chart up for a
Yeah,
moment?
let's do that now. I'll just pull that up. There we go.
Okay, so if we're looking at the chart, we've got signal screener on the left-hand side. You've got the yellow and orange, yellow and pink boxes there, and you can see now, I think it's an 8-day countback. It's been in that red zone now.
Yeah.
Started buying puts, which was Monday the 31st. Just creeps into this month's, technically speaking, and pretty good idea at the time too.
Well, you can see on the left here from the charts is our signal screener. So that's what we publish every morning. The red box being a bearish, yellow box being a bullish signal. And on the right, obviously, is the chart of the XJO, which is the ASX 200 index. Now, obviously, we've called this, and I'm going to pull this back to us now, gentlemen. So faces on for the camera. We ended up buying put options, which I'll let Gibbs chat about because it was your call that got us in for that mode of protection.
Yeah, so what happened is the volatility spiked even though the price was still going up. So it's very unusual to get a signal that the market's going to turn when it's on its highs. Usually the market has to drop first and then the signal screener goes red. But volatility picked up and the price was still going up. And so I think we were all second guessing ourselves to a certain extent, but it's put out so many good calls in the past that we went out, had faith in the signal screener, bought the put options, and then of course a week later the market in the US was down 5% in one day. So
and our Aussie market down 4% the same, right? Roughly.
That's right. Yeah.
It's interesting. I think we've touched on this in previous broadcasts. That ability to detach the emotion and detach the personal perspective and actually have something subjective that's saying, hey guys, it's a red box, we're going to treat this differently, even though, and I agree with you, looking at this market, I don't know if you're able to bring the charts back up, but if we look at that chart on the right, which is the XJO, we've been sitting very, very neatly in that 59 to 6,200 level on the XJO for a number of months now, and we're hitting 6,200 again. And normally, as you say, we don't expect to see volatility increasing in a rising trend, which is exactly what we saw. We've hit that turning point and boom, off she's come again. So it's been, a fairly disciplined market from a technical perspective, but it didn't feel like volatility should be increasing. It actually felt probably the reverse, I think.
Yeah, it's the opposite to what we saw a few months ago when we all felt like we should be bearish on the market and the market kept going up. And now we're on the highs and everybody's getting a bit exuberant about things. And all of a sudden the signal screener went bearish and everybody still wants to be long. So they've only just changed their minds more recently to being bullish and it's gone bearish. But I think at the moment, this may only be a short-term pullback. It may not be a big dip. So the signal screener identifies risk-on areas and that doesn't necessarily mean you're going to get a massive big sell-off. That only happens about 25% of the time. The rest of the time it just says that you're in a short-term pullback. You should probably be careful because big falls can come from here. And that's exactly why we bought put options rather than using a static hedge or actually selling out our long positions.
I think it's a pretty good idea. I mean, the proof of the pudding will be in the eating, but ultimately, we'll no doubt see how this month progresses forward. But we've been on some really, really good profits. Actually, a good opportunity to talk through some of our trading for last month.
Yeah, we had a fair few trades. We were fairly active, even though we had that red box at the last couple of days of the month. So just reading my notes here, we had a total of 24 trades over basically, almost 30 trading days, or maybe just a touch less. So more than roughly about one trade a day thereabouts. Now, out of those 24, 10 were winners, exercise for max profit, which was great. A lot of our clients made money. The other 14 are still active. And out of those active trades, we've actually bought put option protection on all of those given the red box. And I know, Gibbs, I actually learnt something personally from you. The whole notion of using delta to purchase your put options is something I didn't know before. We know obviously you ventured into this red box. Do you mind just explaining that to our viewers a little bit better?
Sure. So we know with the signal screener that only 25% of the time are we going to get an extended sell-off. The rest of the time we're just in a short-term pullback, but you have to manage your downside risk. So by buying a put option with a delta of 0.3, if the signal screen is wrong, and if we're wrong in our view, and the market does push back up, we will gain more on the stock holdings than what we'll lose on the put options. But if we do get a big sell-off in the market, and the market drops a lot, say it drops 10 or 15%, or lo and behold 30% like it did back in March, what will happen is the delta on those put options will increase, and you'll get a pretty good hedge below the strike price of those bought puts. So if the market goes back up, you make money. Okay, you're not going to make the full 100% of the profit. You'll make about 70% of the profit you'd make without holding the puts, but it doesn't cap your upside. And if the market tanks, well, you've got the put options in there to provide some protection during the down risk on time. And as soon as the signal screener goes bullish, again, obviously we'll sell those bought puts and back to just holding stock.
It's interesting, isn't it, when you start to layer up the different components. So, obviously this is technically speaking, we've got a chart that's sitting very neatly within our support and resistance levels. With the modelling that you use on a purely technical basis, looking at vol and different instruments in that space, the red lights come on and it's time to take a little bit of caution. Then we dive into the specificity, if you will, of the options trading, where, I guess for want of a better description, it's relatively cheap insurance. And there's a little bit of an excess there, but nonetheless it's giving you that peace of mind, and for the small dollar amount for that peace of mind, if we're wrong, that'll actually be something to celebrate, because net the clients are still going to win. So it's almost it's a no-brainer. It's a very, very smart, unemotional way of really protecting some of these positions.
One interesting thing I'd like to point out, I know you and I have done a whole podcast on this, is the disconnect between fundamentals and technicals. As you just mentioned before, it doesn't feel like there was a sell-off coming, although the signal screener from a purely technical point of view kind of called that. It's just so interesting how just focusing on technicals in this current market tends to be working a lot better than fundamentals.
Well, we're in a shorter term market, there's no question about that, and fundamentals typically, in the way that most people use them, are looking out for that longer term game. Technicals being orientated around the timing is pivotal in this kind of traders market, and certainly a man over here, Yoda, is picking it like a nose, as the saying goes, and long may it continue. But that's the validation of using multiple types of analysis. And I think the biggest takeaway is why we use volatility. And as options traders, it's probably where a specific skill set sits very, very strongly. And volatility is one of those few measures in the marketplace which is forward-looking. Very, very important.
Absolutely. And I guess that begs the question of where are we heading now, gentlemen? That's where are we going?
Get the coins out.
Yeah, get a coin out, get a crystal ball, Gibbs. What have you got?
Well, we'll be bearish until the signal screener turns bullish again.
Absolutely.
It's as accurate a signal as anything you're going to get. But I completely agree with what AB just said earlier. Fundamentals provide a really good long-term look at the markets, but trading and investing are quite often poles apart. With trading, you're not going for the undervalued stocks. In fact, a lot of the stocks that you're trading are the ones going up, and they're quite significantly overvalued if you look at them on a fundamental perspective. I mean, if you look at the tech stocks now, fundamentally they're awful. They're so overvalued, you wouldn't touch them from a long-term perspective with a pole.
That's right. I mean, Amazon's at a PE of 122 times at the moment, Afterpay 78 times, CSL 44 times. And you look at that compared to the Commonwealth Bank at a very lazy 12 times earnings. Fair value for some people. That said, I'd probably be more inclined to want to buy Amazon right now at 120 times earnings than the Commonwealth at 12 times earnings.
Yeah, the CEO of Amazon's clever. You don't look at it on PE ratios, you look at it on operating cash flow, because what he's doing is he's buying and amortizing a whole lot of stuff which has a longer shelf life than the depreciation that you can write off.
You must be an accountant and a former golfer. That's right, you are an accountant too, aren't you? There we go. How about that?
One thing that's probably interesting as well, we've forgotten almost, AB, is that Mr. Gibbs has just rolled out in the month of August his US momentum stock portfolio trading system, which has proved to have great results for some of our more advanced options clients who are trading derivatives in this space. For example, Starbucks is a trade that we had an advanced options recommendation on. 323% profit for a couple of days in the market.
We had a good run. We had a really, really good run over the last month on the US market. We bought the dips. The market, everything we touched turned to gold. We were focusing on the stocks that were going up. They were all the ones that had some great results. And because we were buying call options, and because you can get a bit of leverage and some pretty good bang for your buck, we had some great profits.
Not to mention our bull put spreads, our bear call. Bull put spreads, our bull call spreads, and a few other jiggery pokery we did in that market.
Yeah, it's been a good run. When you've got the direction, the momentum right, away you go. For what it's worth, there is an enormous disconnect right now between the Australian and the US market. We're seeing everyone. The Aussie's nice and strong. We don't need a nice strong dollar right now. A weaker dollar would probably help us a little bit in terms of trade. But I think that reflects the amount of money being printed in the US, devaluing the currency. But we've got a stock market over there that's been incredibly strong. We've been in this range bound, yet we've still been able to earn good money for our clients. And it's interesting, you talk about the number of full profit trades. A lot of people would say, well, does that mean that a lot of your trades were losers? Not at all. They're still open and paying cash flow. That sideways shaped market that we've been for the Aussie certainly I think has lent itself to covered calls, but the advanced options work that we do on that US market in particular, that market is just prime for it. And heck, you might want to use options to get exposure to it rather than paying $3,200 for your Amazon shares. Right now you can get exposure for tuppence halfpenny using derivatives, which is our bread and butter.
Yeah, well the great thing is when the signal screener is read and it is on a risk on period, call options, if you do want to go long a stock, are great because they're limited risk.
Nice and cheap.
You can buy them for 3 to 5% of the stock price, even less than that. So they're a cheap way of getting exposure. And if the market tanks and the view that it's going to go back up is wrong, the most you can obviously lose is that 2 or 3% that you outlay on the call. So when you're in a risk on period, bought calls are better than holding stock, which of course you can get some pretty big losses on if you hold it all the way down to the lows on a big pullback.
Well, that's right. You think about it, if you buy an option, you're paying 3 or 5% to buy that call, and your stop loss on the stock is likely to be probably 4 or 5% for most people if they're running stops on their stocks. Net the dollar risk or percentage risk is pretty much the same, but the dollar risk is massively different. But,
and you can get gaps as well. You can gap through your stock, whereas with a call,
that's it.
Your premium, that's it.
You really got no choice. It's a built-in stop loss. It either expires with some value or it doesn't, and there's two sides.
In saying that, when the market's going up and you're in a risk-off area, it is far better to hold stock or CFD rather than an option. You'll get better bang for your buck. But certainly for managing downside risk, options are great.
Fair enough too. Well, I reckon we're going to be range bound. I think we're going to get that turning point again down at 5,900, and I think we're going to see the signal screener come up with a magic yellow colour, and we'll be back to the races again for 6,200. That's my call over the next few trading sessions, I think, and that discipline of the range that we've seen, I think it's likely to stay for us here in Australia. We haven't run away to the races like the US, and I think that sideways pattern is going to continue to lend itself very, very well to what we're doing here.
Sure. No tech stocks means no booming market like the US, right? If we stay in a sideways fashion, we'll sell calls for income and we'll keep making hay while the sun shines.
Absolutely.
Right. Don't forget, September in America is often a very, very bearish month. Historically, it's been the worst performing month for US stocks. So often bottoms out and starts going back up come early to mid-October, but food for thought.
So go away in May, sell all your portfolio. And we've seen a market rally too, so I wonder, this is a year for the record books, isn't it? We could argue this, we could argue that, but ultimately all the arguments go out of the window when you use technicals, which I guess is the foundation of this particular session together, and that is the inability to overlay opinion or history or subjectivity and just look at the hard-nosed facts. Is it yellow or is it red? And then we make a decision off there, which is signal screener in its absolute totality, which is what we do.
Almost seems too easy.
Doesn't need to be hard. The hard part's following it.
Hard part was building it. Well done.
Righto, boys. I think that might be time to wrap things up as we get a little bit chirpy here. But look, thanks very much for joining us. This was a great episode, and always to have Yoda on a broadcast. How good is it?
Thanks for having me.
Pleasure. Thanks very much.
Thanks, boys.